just coming up in just over a month's time. We're excited to be hosting our annual investor conference. Many of you may have been to that before, but we welcome all of our investors to the annual investor conference. It's at the Royal Institute of British Architecture, or WHEB, in central London on the morning of November the 28th. We're doing a morning format this year, whereas in previous years we've done the afternoon. We're delighted that Sir Alok Sharma, former president of COP26, will be giving the keynote, and that'll be, I think, pretty much the last thing he does before he heads off to COP28 in Dubai, which starts the next day. So that'll be quite an attraction. We're delighted about that. We've also got a couple of portfolio companies, Bharat Sarko and HelloFresh, will be on the stage, and we'll be having conversations with them, as well as the usual format of the annual review and some longer term perspectives and a chance to answer questions. So if you can, on the 28th, do come along to that. We'd be delighted to welcome you. The sign up and registration is on our website. But that's enough of the plug for the next event. But so let's get back to this morning. And at that point, I'll the agenda this morning is that Claire will speak through Q3 and some of the highlights, the events of Q3, and give you an overview of what's been happening in markets and performance. And then Seb is going to talk about our approach to pharmaceuticals and investing in the pharmaceutical industry, and also an update on UK climate policy, or some reflections on what we've seen happening there over the last few months. So that's the format there. As I say, that'll take about 40 minutes, and then we'll make sure there's plenty of time for questions. So without further ado, I'll hand over to Claire at that point. Thank you.
Thanks, George. So I'm going to start out by giving you a bit of an overview of Q3, what markets are doing, how our strategy performed, and giving a few thoughts on outlook before turning over to Seb. So the first thing to really talk about is that it's been an extraordinary summer. Extreme heat and storms have impacted most of the Northern Hemisphere. It's something we say probably every year, but it's definitely getting worse. This September was the hottest on record, and for a time, temperatures actually reached 1.75 degrees above pre-industrial averages. You might remember we're supposed to be aiming for 1.5, so that's not great news. And as a result, we saw a number of, pretty extreme weather impacts during the summer. Greece saw one of the worst wildfires ever seen in the European Union. New York was impacted by a flood which brought its transport sector to a standstill. And the US came very close from seeing landfall from a Category 5 hurricane called Hurricane Lee. Thankfully, it was downgraded to a tropical storm before it reached land, but it just serves as a reminder of how dangerous these extreme weather events can be. Meanwhile, in the cleaner energy sector, we've seen some disappointing news, particularly in offshore wind. Now, clean energy development is capital and debt intensive. Often developers have to raise a lot of debt. They then build the asset with the assumption that electricity prices will be high enough for them to generate a return over their cost of capital. But due to high inflation and soaring input costs, particularly for steel, which is a key input into wind turbines, we've seen that kind of spread, that return on investment, become really quite difficult to achieve for these developers. And that manifested in a couple of ways in this quarter. Firstly, Ørsted, which is an offshore wind development giant in Europe, came out and said that they may need to write off nearly $2 billion worth of assets because they're not able to generate a return. Mads Nipper, the CEO, has taken to LinkedIn to post a number of quite rambly posts, basically rallying support and encouraging policymakers to finally step in and do something. We don't own Ørsted in our strategy, but we have seen impacts in other areas in the cleaner energy sector, which we'll talk about in more detail. Meanwhile, in the UK, you might have heard that a recent auction for an offshore wind site attracted 0 bids because the price the government set for electricity was too low for the developers to actually generate a return on their investment. You might think that these things should serve as a wake-up call for policymakers, but instead we've seen political peacocking lead to a number of environmental policies being scaled back. Here in the UK, Rishi Sunak has scaled back a number of his environmental policies, which Seb will talk about in more detail. And that guy on the left is German Vice Chancellor Robert Habeck, who's looking pretty miffed because one of his environmental policies has had to be watered down quite significantly. He had originally planned for an outright ban on oil and gas boilers in 2024, but that faced significant public and political backlash. And so he's had to walk that back. And the German government has actually said that under the new policy, they're very unlikely to actually meet their 2030 emissions targets for the building sector. And this is how the stock market has reacted. So a flurry of bad news in the clean energy space, high interest rates, soaring input costs, policy challenges, regulatory change, slowing demand and development, has led to a broad-based sell-off in the cleaner energy sector, which you can see in that chart on the left in that light green line. Meanwhile, OPEC production cuts and general fears of oil tightness has led to the oil price nearly reaching $100, which is the highest level we've seen this year. And unsurprisingly, fossil fuel companies have benefited from that oil price and been rewarded by the stock market. And this is how our strategy performed during the quarter. You can see that our fund meaningfully underperformed both the MSCI World Index and the IA Global Sector. And that really does come down to that divergence of performance between the cleaner energy space and fossil fuel energy. We own close to 6% of our fund in cleaner energy because we absolutely believe in the long-term demand and need for decarbonisation technologies. But over the near term, that has been a headwind. Meanwhile, we don't own any fossil fuel energy companies, and I don't think anyone would expect us to. So we haven't benefited from that tailwind, which has been experienced in the MSCI World and in a lot broader global equity funds. And this is how the performance looks over the long term. So over the last 12 months, in absolute terms, our strategy is broadly flat, but we have meaningfully underperformed the MSCI World Index, which has generated over 11% return. That's really been down to Q3, which has been particularly challenging. Meanwhile, over the longer term, that growth to value rotation we saw at the beginning of 2022 is continuing to be seen in our long-term performance. Now, it's important to put this into context. You'll see from our competitors in the impact space that we are all struggling right now. And that really comes down to the minimal overlap between our investment opportunity set and our MSCI World Index. For the WHEB fund, we have only a 15% overlap with the MSCI World, and we don't own any big cap tech or fossil fuel companies because they don't enter into our investment universe. And those two forces have really been what's driving markets over the last couple of years. ESG funds have generally fared a bit better because they often own a lot of mid-cap tech. Sorry, not mid-cap tech, large cap tech. And it's important to remember that they're not looking at sustainability through an impact lens. So they have a much more broader investment opportunity set, and they're more focused on operational ESG. We also have a mid-cap bias in our strategy, and that's been a headwind because mid-caps have underperformed large caps over the last couple of years. At the AIC, we'll talk about our long-term performance in more detail. So if you want to come along to that, do please sign up. But for this webinar, we're going to be focusing mainly on Q3. So this is how our thematic attribution looks for Q3, and you can see that cleaner energy as a theme was our most significant detractor from absolute returns. Resource efficiency was also weak due to a number of semiconductor holdings, which we'll talk about in just a moment. More positively though, two of our social themes, education and well-being, have proven more resilient during this challenging market environment. So moving on to talk about some stocks now. In the cleaner energy theme, SolarEdge was our most significant detractor from returns. SolarEdge sells power optimizers and inverters to the rooftop solar industry, and they serve both residential and commercial customers. You can see from the chart on the left that in 2019, SolarEdge's revenue was split roughly 50-50 between the US, which is that dark green bar, and Europe, which is that kind of mid-green. But in 2023, that picture looks very different. And this is for two reasons. Firstly, the US has seen a deterioration in demand for rooftop residential solar energy, partly because of higher interest rates, but also because of a new policy called NEM 3.0, which has taken effect in California. California is the US's largest market for residential solar energy. It's the golden state, and homeowners that have a solar system have often generated so much solar energy that they can't actually use it all themselves. So historically, they've been able to sell that excess energy back to the grid to make a tidy profit. But recently, the utility companies have got a bit tired of this, and they've lobbied for a new policy called NEM 3.0, which basically makes it a lot less economically attractive for homeowners to sell excess solar energy back to the grid. You can see from the table on the right that the interconnection fee, which is the cost to actually do this, has gone up from a $75 one-off fee to up to $64 every single month. So the cost has really exploded. Meanwhile, the solar credit rate, which is the price that homeowners receive for actually selling this power, has gone down from 30 cents per kilowatt hour all the way down to 8 cents. So you can see how it might make less sense for a homeowner in California to own a rooftop solar system today if they can't make that profit on the excess energy which they used to be able to make. So that's led to a meaningful deterioration in demand from residential rooftop solar in the US. Meanwhile, though, in Europe, we've seen an explosion in demand, particularly from commercial customers. And you can see that the demand in Europe has been so great that it's actually been able to offset the decline in the US and enabled SolarEdge to deliver absolute growth in revenue for this year. And that's really been down to the Russia-Ukraine war, which has caused this energy crisis and has led commercial customers to want to pursue energy independence and have their own solar systems. What we've been seeing this quarter, though, is that demand in Europe has started to normalize, not decline, just slow down a bit from the supernormal growth rate we've seen previously. That's led to a temporary lull in demand in Europe as distributors are holding on to inventories which they now need to sell before they can buy more from SolarEdge. So this has really explained the weakness in SolarEdge this quarter. But there are two reasons why we think we can be positive about SolarEdge's long-term prospects. The first relates to NEM 3.0 in California. Because what do you do if you generate so much solar power that you can't use it yourself and you can't really sell it back to the grid anymore? Well, you buy a battery. The diagram on the left shows the kind of distribution of power from a solar system throughout the day. So it's noon, the sun's high in the sky, you're generating loads of solar energy. You're probably not at home because you're either at work or you're out and about doing stuff, and you can't really sell that solar energy back to the grid anymore. So you buy a battery, you charge that battery and you use it when you get home. And there's good reason to think that NEM 3.0 is going to result in an explosion in demand for batteries, because we've already seen this happen in Germany. Germany has a similar policy, and we don't think it's any coincidence that the attachment rate of batteries to a rooftop solar system in Germany is 80%, compared to just 18% in the US. And when that demand comes through, SolarEdge is going to be ready and waiting to sell those batteries. They've been ramping capacity very quickly, and they're going to be ready to serve the market. But the other reason to be positive is that we think that European commercial solar remains structurally supportive over the long term. You can see on the left-hand side some LCOE, or levelized cost of energy analysis, which sets out the kind of average costs for different power sources. And you can see that residential solar is actually kind of expensive, which is partly why demand has deteriorated in a high interest rate environment. But commercial and industrial solar is actually quite cost competitive, not just relative to residential solar, but also relative to many fossil fuel energy sources like coal, nuclear, and gas. And so we think that commercial customers in Europe are going to remain economically incentivized to invest in commercial solar. And when you add to that the demand for ESG-friendly technologies in Europe, we think that's going to be doubly supportive. The second most significant detractor from returns from a thematic perspective was resource efficiency, and that was due to a number of semiconductor companies like Silicon Labs. So Silicon Labs is a specialist in Internet of Things connectivity technology. So basically, these are semiconductor chips which go into all of the smart stuff you might have in your house that connects to the cloud. And you might wonder why this is in our resource efficiency theme. Why does this save energy? Well, if you think about it, if you connected up all the electronics, appliances, heating and air conditioning units, electric vehicles in your home, and then you could see on your app how it was drawing power, how much it was using, how that changed throughout the day, that can actually be really impactful in enabling you to understand your energy consumption and actually reduce your overall energy consumption in the home. So it's no surprise that Silicon Labs does have a meaningful exposure to the consumer sector, and that has been weak recently because we're in a cost of living crisis and people are just buying less stuff. But what's been more of a surprise this quarter in particular is a slowdown in demand for factory automation technology. So just like you can connect everything up in your home, you can also connect everything up in your factory and have the same effect. Now, what's been kind of surprising over the last year is that even though purchasing managers' indexes have been declining, and these are typically a good indicator of industrial demand, we've still seen pretty robust demand for factory automation equipment and technology. The theory being that because wage inflation is so high, a lot of companies are thinking, well, I might as well continue to invest in factory automation because that way I can bring down my labor costs over the long term anyway. But recently, this quarter, we've seen that starting to slow, which has impacted Silicon Labs as well as other companies in the semiconductor space. That was disappointing for the market, but we think it's largely cyclical and relative to the economic environment rather than due to something fundamentally wrong with Silicon Labs. So we don't see any reason to revise our thesis. Turning on to some more positive news, I mentioned that two of our social themes, education and well-being, proved more resilient during the quarter. In education, this was down to actually our only holding in the education space, which is Grand Canyon. Grand Canyon derives most of its revenue from providing services to a university in Arizona called Grand Canyon University. It has a reputation for providing a really high quality education at a low cost. They actually haven't raised their tuition fees at all since 2008. Unsurprisingly, during the pandemic, we saw a significant slowdown in the number of students enrolling to go to Grand Canyon University, because who wants to go to university during a global pandemic? And happily, we've started to see that reverse now, and students are now coming back to campus, which is going to be good for Grand Canyon's revenue growth. But what's been more interesting is actually the persistent growth in online enrollments. So online enrollments for Grand Canyon were actually up 20% year on year, which is perhaps strange if you're thinking that students are still going back to campus. We think this might be indicative of the new normal, where workers are, maybe spending less time commuting, more time working from home, and perhaps investing in online education. But that's just a theory, and we'll see how that plays out. Meanwhile, HelloFresh in our wellbeing theme has proven quite resilient this year after having suffered a pretty bad year last year. HelloFresh is still struggling to add new customers in this cost of living crisis. But one thing that we think that the market has consistently underappreciated with HelloFresh is that they have a core of about 7 million active customers, which haven't gone anywhere after the pandemic. You can see on the left-hand side, those green bars represent HelloFresh's customers, and you can see that it's been pretty stable since 2020. Meanwhile, in this inflationary environment, HelloFresh have been able to put up their prices and even sell their customers more stuff. So the average order value, which is that black line, has actually been increasing, and their customers have stayed relatively stable. What's really impressive, though, is that while all this has been happening, HelloFresh have actually been able to bring down their procurement expenses as a percentage of their sales. So they have a number of ways that they can do this. They can tweak menus to prioritize seasonal ingredients that are maybe cheaper and more widely available. They also have a back-end system where farmers actually bid and compete in auctions to fill certain ingredient capacities. So they get a good price of ingredients as well. And this has enabled them to bring their expenses down while their prices are going up and their customers have stayed stable. So their margins, their profitability is actually looking pretty healthy right now. And we think this is indicative of actually quite a strong business. So that sums up how our strategy performed in Q3. And it really does mostly come down to that weakness in the clean energy sector and related technologies and our lack of exposure to fossil fuel energy. There are some reasons to be positive about the near-term future for cleaner energy. You might remember from recent webinars that our holding in Vestas Wind Systems, which is a wind turbine manufacturer, has been challenged recently due to that slow demand in the wind sector. But positively, we've started to see what we believe is a positive inflection in order intake for Vestas's wind turbines, which could serve as a leading indicator for the rest of the cleaner energy sector. And you can see that on the left-hand side, the one-year rolling average order intake has been trending up. There are two reasons to think this might be happening. The first is that inflation and interest rate expectations have begun to normalize, as you can see on the right. And that may provide a more friendly environment for developers to invest in new cleaner energy assets. But another thing that's important is actually the US Inflation Reduction Act, which you might think is old news now. So you remember it was announced last year and it commits about $400 billion to decarbonisation technologies. But what they failed to do when they set the policy was they actually kind of didn't make clear some of the policies around tax credits. And so some of the wind developers have been waiting for guidance so that they can actually understand what they need to do to access the tax credits in that policy. That guidance has finally started to come through, which is serving to create confidence in the wind sector and hopefully spurring an inflection in demand. So that's one thing that we're going to be looking out for in the near term. But another thing to be keeping an eye on this quarter is COP28, which is happening at the end of November. And we actually have the UK's delegate, Anok Sharma, speaking at our AIC in November. So if you want to hear from him, do sign up. There are two things that we're going to be watching for at COP28. The first is negotiations around the Loss and Damage Fund. So you might remember that this was established last year at COP27, and it basically serves as a vehicle for wealthy nations to transfer wealth to developing nations to basically compensate them for the loss and the damage caused by climate change. So it seems like a good thing, and they did agree it last year, but what they failed to do was agree who was going to pay into it, how much they were going to pay, and what the money was going to be used for. So basically any of the key points. And they kicked that down the road to this year. And so we're going to see that happening at this year's COP. And it's going to be interesting because you might have seen that the US has already started to wrangle their way out of paying for certain things like humanitarian disasters through this fund. So that's probably going to be a contentious issue. The other thing we're going to be keeping an eye out for is rumours that some states are going to lobby to do away with the 1.5 degrees C target established in Paris in 2016. And that would be disastrous because it's widely considered true that if temperatures reach above 1.5 degrees above pre-industrial averages, that's going to lead to more persistent, more frequent and more extreme weather events. And so our extraordinary summers may be about to get worse. With that in mind, we've started to take the view that if we're investing in environmental impacts, it's not enough just to invest in decarbonisation and resource efficient technologies. I think it's time for us to face up to the fact that our world is already changing. We're already seeing increasing frequency and intensity of extreme weather events. And we need to think about what impact that's likely to have on our people, our crops, and our infrastructure. To that end, this quarter, we've officially introduced a new sub-theme for our environmental services theme. So this is going to be called climate adaptation. And it may sound like a pretty bleak prospect to be investing in climate adaptation, but rest assured, we still absolutely believe in the long-term demand for decarbonisation technologies. It's just that we have also identified a number of high return, high impact opportunities in the climate adaptation sub-theme. And some of these are actually in our strategy already. Advanced drainage systems provides stormwater infrastructure, and Train provides heating, ventilation and cooling systems. And we think it's no coincidence that these two companies are among some of our best contributors to returns over the last 3 years. So that sums up Q3, and I'm going to hand over to Seb now, who's going to talk a bit about Big Pharma and the UK's climate policy.
Very good. Thank you very much, Claire. So yes, as Claire's just said, I'm going to focus on two aspects of the portfolio that we thought would be interesting for you to hear about. The first is around our investment in big pharmaceuticals, and the second is to come back to the comments that Claire made about Rishi Sunak and his rolling back of targets on net zero carbon. So just to turn to pharmaceuticals first. So big pharma is a bit of a dirty word, I think, for many people. The industry has had a reputation for pretty unethical practices. There are two particularly egregious, extreme examples of this. Many of you, I'm sure, are familiar with the story of Purdue Pharmaceuticals and their marketing of OxyContin in the US, which is a highly addictive opioid used as a painkiller, reportedly led to the deaths of over 645,000 people. It's been dramatized as a Netflix drama called Painkiller, with Matthew Broderick playing Richard Sackler, who's the CEO and was largely responsible for the very aggressive approach that they took to compliance and marketing, which was the cause of so many deaths. The other extreme example is a little cartoon there, a guy called Martin Shkreli, who was the CEO of Turing Pharmaceuticals. He bought a drug called Daraprim in 2015 and literally overnight increased the price by nearly 5,500%, basically making the drug essentially unaffordable for it to stay alive. So these are pretty extreme examples, and Shkreli actually ended up in prison for a period. But across the industry, we saw less extreme practices that were pretty standard across the industry. So, for example, one of the key things was around how pharmaceutical companies could extend patents to ensure that they could continue to charge high prices for their branded drugs. And they did this in various ways by making small changes in the composition of the drug, for example, by slightly changing the delivery mechanism, or in one case, simply adding a little colored stripe to the pill, and then applied for patents to protect that new drug for an extended period. And in fact, as this little quote from the Journal of Law and the Biosciences, in a study they did, they found that between 2005 and 2015, 78% of drugs receiving new patents were not new drugs at all, but existing drugs. So this was pretty standard practice. We'd always had a pretty dim view of it, considered it to be irresponsible at best, and had very limited exposure to any US pharmaceutical activity. But two things have changed, we think, which make this a much more interesting space for us to invest in. The first is regulatory change. Back in 2016, Hillary Clinton tweeted that she didn't think it was appropriate that there was no justification for price hikes for EpiPens, which are used by diabetics. And that caused the collapse of some pharmaceutical companies' share prices. And really, since then, there's been this figurative sword of Damocles hanging over the pharmaceutical industry, the threat of regulatory action. And now actual regulatory action in the form of the Inflation Reduction Act. Claire mentioned that earlier on, and we've talked about it in previous webinars on the environmental side, but there are also provisions in the Inflation Reduction Act that empower Medicare, the government's health insurance program, to negotiate or really dictate prices for 10 of the 50 drugs that represent the largest outlay for Medicare. And they can add additional drugs to that list from 2026. So the threat of regulation, and now actual regulation, has been a threat to the industry, and has been pretty effective in limiting drug price increases to more or less in line with inflation. So we think we have a much healthier, it's not perfect, but a much healthier regulatory environment that controls these egregious practices that we've seen previously in the industry. The second thing that's happened is that we have seen a dramatic improvement in the quality and extent of the drug development pipeline. And you can see that here in this chart. From 2017 to date, there's been a nearly 50% increase in the number of candidates that are going through the trial process. And many of these are genuinely breakthrough new therapies. There has been a tailing off of that in the last couple of years, and that's really due to COVID. But you can see over that period how oncology in particular, but also neurology, have seen a dramatic increase in terms of the number of candidates. And a big contributor to this is the biopharmaceutical industry. Now, biopharma is a manufacturing process that relies on living organisms to produce the therapies, and these are so-called large molecules that are often composed of proteins. And this is in contrast to traditional pharmaceuticals, which are which are made in chemical processes. And these new therapies in oncology and neurology, for example, are coming from these new biopharmaceutical processes and include things like monoclonal antibodies and gene therapies. And in fact, cell and gene therapy and mRNA vaccine technology between them account for over 20% of the drug development pipeline today, up from just 11% a few years ago. So we've really seen two very important changes. The regulatory environment has improved, and we've seen this flowering of innovation in the industry, really driven by this new science around biopharmaceuticals. So that's made us much more interested in big pharma and pharmaceuticals more generally. We are still very cognizant of the need for a responsible approach to pricing and indeed wider access to the therapies. And we've developed a due diligence checklist looking at both pricing and access, looking at policies and processes and performance, considering things like the role and status of health economists in these pharmaceutical companies, the quality of disclosures around pricing and cost benefit of the new therapies. The company's history of price increase is also interesting. And then there are third parties that issue research on the value of new drugs. So we have the National Institute for Clinical Excellence in the UK. We also have ICER in the US, and then third bodies like Access to Medicines as well. So we're looking at all of that information in order to make sure that a potential company for our portfolio is adopting a responsible approach to these issues. And the consequence is we have expanded the number of pharma companies in the portfolio. CSL has been there for some time, but we added Genmab, which is a Danish company, a couple of years ago. They have a particular focus on monoclonal antibodies that are used in treating various types of cancer. AstraZeneca, obviously a UK company, also with a very interesting pipeline of therapies around cancer. They're both in our global strategy. And then we've also got Novo Nordisk in our European strategy, and they obviously have their GLP-1 franchise, which is a new product that's addressing diabetes and also, of course, obesity as well. So I hope that gives you some sense of how we're approaching what we think is a very, very impactful area, really tremendous health outcomes that are coming from these new drugs, but approaching it in a way which is measured and focused on responsible practices as well. So that's the pharmaceutical industry point that I wanted to make. I did also just want to touch on where we are on net zero. I think the first thing to say about this is we've kind of been here before. As Mark Twain famously said, history doesn't rhyme, it doesn't repeat. It doesn't literally repeat, but it does rhyme. There are echoes that you can see in historical precedents. And I think we absolutely see that with Rishi Sunak's comments around rolling back various milestones around net zero carbon. It is almost exactly 10 years ago that David Cameron made his cut the green crap, quote unquote, statement, where he basically stopped any onshore wind development in the UK and dramatically cut support for insulation. Rishi Sunak, we think you can hear an echo of that. Partly, we think Rishi Sunak is responding to, it's a political calculus that he's taken to shore up the right wing of his own party, something that David Cameron would definitely recognize. But I think it's actually, there's a strong case that the move will actually alienate much of his own parliamentary party. There are a lot of MPs who are committed to net zero carbon, and indeed much of the electorate. A lot of the opinion polls that we've seen that address this topic have found that Conservatives actually tend to want more action on climate change, not less. So we think there's a risk there. What has been particularly different from the reaction to David Cameron's statement is the reaction of the business and financial communities. And I've just listed some of the groups and some of the things that they've said, the backlash to the backlash, if you like. Groups that are mainstream representatives of mainstream industry and finance. So Make UK represent all of the manufacturing industry. The Green Building Council will represent pretty much all real estate developers. Corporate Leaders Group are big companies like IKEA and E.ON. And then, of course, we've added, the mighty WHEB have added our own voice to the statements that the investment community and finance community have put out to Rishi Sunak as well. Of course, not every business has responded in this way. The SMMT, which is the Society of Motor Manufacturers and Traders, have had to find a middle route between Ford on the one hand, who are basically incandescent about this, having made major investments in EV manufacturing infrastructure in the UK, and Toyota, who've been a real laggard on investing in battery electric vehicles. So the SMMT have had to find a middle ground. But generally speaking, there's been a very vigorous backlash from business and from finance on this point. The logic or the argument that politicians in the UK and Europe have used in watering down these commitments is really to say that it's to help people with the cost of living crisis. But actually, many of these technologies are already cheaper than their fossil equivalents. So as we know, onshore wind and solar power are the cheapest forms of power generation across most of Europe. Onshore wind is the cheapest form of power generation in the UK. If Cameron had kept to the green crap back in 2013, our electricity bills and our energy bills overall would be £2.5 billion lower today than they are. And if we kept installing insulation in buildings, our energy bills would be £7 billion cheaper today. So cutting the green crap definitely didn't save people money. And the same is going to be true of electric vehicles as well. You can see the chart on the left-hand side around the forecast, the actual penetration of electric vehicles in terms of new car sales. These are global numbers compared to the forecasts, and people have bought electric vehicles more quickly than the industry had expected, and that's expected to continue. And part of the reason for that is actually the cost is much lower than people had expected. The ownership of an electric vehicle is already substantially cheaper than, the use of an electric vehicle is substantially cheaper than an internal combustion engine vehicle. And although the initial price you pay is higher today, the research by Bloomberg, which you can see on the right-hand side here, suggests that by 2025 in Europe, a number of vehicle types will be at price parity with internal combustion engines, with all vehicles in Europe really meeting that target by 2026. So the milestone that Rishi Sunak has pushed back is from 2030 to 2035. It's almost certain that electric vehicles will not just be cheaper to run by then, they are already, but they'll be cheaper to buy as well. So this definitely won't be saving people money over this time period. And as we say in the title here, politics does really need to catch up with the economics on this. And the reason I wanted to give, that's a sort of micro case, I wanted to give you the macro case as well. This is some research that's just been published by the International Energy Agency. And it shows how, and I'll just walk you through the chart in a second, but it shows how the net zero emissions scenario is now considered to be cheaper than the business as usual scenario. So there are just a few things to point out with this chart. So you've got 3 different periods: historical period 2018 to 2022, and then these 2 scenarios in 26 to 2030 and 2046 to 2050. And you've got the 2 different scenarios: the STEP scenario, which is the business as usual scenario, and the net zero emissions scenario. And you can see in the 26 to 2030 time period how the investment in clean energy investment, the green part, is substantially higher than in the STEP scenario. And you're getting a slightly lower spend on fossil fuel, the fuel spending. But by 2046 to 2050, although that's even higher, the green bit is even higher, you're already seeing this significant reduction in the fuel spending. And actually every year from 2030, the saving that you get from reduced fuel spending more than compensates for the additional capital investment that you're having to put in terms of the green technologies. And over the period out to 2050, the cumulative savings are 12 trillion US dollars. This is global. And that doesn't include the value of lower healthcare costs associated with cleaner air, or the cost of having to adapt as well. So that $12 trillion number was probably much higher. So at a macro level as well, we're now saying net zero emissions is the cheaper way to go over the long term. And the reason for this, and I thought this was just a sort of interesting historical example, the reason for this is just how quickly costs have been reduced in solar particularly, and also battery electric vehicles. And those costs have come down faster than anything in the historical record. So the two examples that I give here on the left-hand side, the Ford Model T, the blue part is the average annual deployment growth over this period from 1910 to 1920. So they were growing, the deployment of Model Ts was growing at about 34% per year on average across that period. And they were delivering about a 9% reduction in costs per year on average over that period. In World War II, World War II aircraft, even higher levels of deployment, over 70% yearly average increase in deployment, cost reduction of around 13%, 14% per year over that period. But when you look at solar PV, delivering cost reductions on average of 18%, and in battery electric vehicles even higher, 19% average annual cost reductions per year between 2010 and 2020. So just extraordinary levels of cost reduction. And that's really what's changed the picture from an economic point of view. But, and there is a big but, we have to be pragmatic. These cost reductions have been amazing and have and still are changing the economics around the technologies. But the latest UN stocktake made for pretty depressing reading. This is how are we doing in terms of carbon reductions? And it clearly indicates that sticking with existing commitments is not enough. We need to accelerate the transition to a net zero carbon economy. But as we're already hearing from politicians, there's very little appetite to accelerate that pace of change. In fact, they want to slightly moderate it. And consequently, we don't think, or we think the most likely path forward is one which does see continued growth in some of these key technologies, faster than people expect, electric vehicles, solar power, probably slower in areas like green hydrogen, carbon capture. But none of this will be enough to get us onto a 1.5 degree trajectory. And so we think in time, as the damage that climate change does, and is already doing, then policy will have to respond and accelerate again. But in the meantime, it's very clear that climate adaptation is going to have a much bigger role to play. If we don't mitigate climate change emissions by reducing if we don't mitigate climate change by reducing carbon emissions, we will need to adapt as well. And that's why, as Claire says, we've introduced a formal sub-theme around climate adaptation. So I hope that's given you a sense of two important areas of the portfolio, pharmaceuticals, and also how we think about net zero carbon. And we've just got a few minutes left for questions. So I'll hand back to you, George. Thank you very much.
Great. Thanks, Seb. And Claire, if you come back on as well, we've got some questions coming in, and we'll try and answer as many of those as we can. Clearly, as Claire's been describing and Seb's just been describing as well, this has been a difficult period in performance terms, both relative and absolute in the last quarter, but particularly in terms of relative performance for a while. So there are a few questions that I think we should probably take straight up on that subject. So I'm going to wrap a few together, Claire, There's one asking if we know how we're balancing our financial and sustainability considerations equally weighted on the shorter term basis. Also, just elaborating on the question about how much of the performance in the last quarter comes from cleaner energy, and then a couple of questions in terms of when, given the environment, given what we're seeing, when might this change? When might this get better? When might this get easier?
Yeah, absolutely. So, of course, performance has been challenging, both this quarter and over the last couple of years. And this is the question as to whether we've been overlooking fundamentals. I'd say absolutely not. I mean, it's a great question because it obviously comes to the heart of what we do, which is, we're looking to deliver positive, sustainable impact through our investments, as well as financial outperformance. And the way that we approach that is to basically say that the impact case is the investment case. So we're looking for companies where they have a product or service which delivers a positive, sustainable impact, either from an environmental or a social lens. And we take the view that that impact has to be good enough and their position has to be good enough that that's going to drive revenue growth over the long term. And so that's kind of looking at the revenue line. We then go on to do some pretty in-depth analysis on the quality of the company itself. Looking at things like, their cost management practices to make sure that they can drive profitable growth, not just absolute revenue growth. We look at their balance sheet to make sure that they can actually fund that growth, looking at their cash flow. We look at their management team to make sure that they have the expertise and, the knowledge to actually capitalize on that opportunity. And then, of course, we look at valuation. And I think that valuation has been, it's been a difficult kind of theme for us, really, in that high interest rates, of course, mean that companies that tend to deliver strong growth do tend to be negatively impacted by a higher interest rate, because they have kind of cash flows which are occurring most significantly in the outer years of a 5 or 10 year forecast. And with higher interest rates, you're using a higher cost of capital to discount those cash flows. So you're basically kind of compressing your cash flows, which has led to valuations coming down. And because in our sector and in our fund specifically, we have a bias towards growth, because we're looking for sustainable impact, which tends to be tied to revenue growth, that has been challenging. But rest assured, we do absolutely pay close attention to valuation. We have recently kind of added to this by adopting a system called Canalist, which is a outsourced modeling provider based in Canada. They provide models which we then build our WHEB kind of modeling framework on top of. We have models for nearly every company in our main fund, and we are absolutely very conscious of valuation, probably more so than many of our competitors, I would say, who take more of a growth at any price approach, where we're kind of more growth at a reasonable price. And then as it pertains to the underperformance, cleaner energy has been the most significant detractor from returns in this quarter, both from a relative and an absolute perspective. But it by no means hasn't been the only detractor. We have also seen a headwind from resource efficiency, which we kind of talked about, the semiconductor companies seeing weakness, particularly from a slowdown in demand for factory automation. So I think that was also a significant headwind, though not as significant as cleaner energy. We also saw some relative detractors from some of our other themes, but it wasn't anywhere near as significant. And then on a relative basis, so relative to our index, that was kind of amplified by the fact that we don't own fossil fuel energy, which performed well during the quarter. So on an absolute basis, we were down kind of 5% and a bit. On a relative basis, of kind of 6.5%. So that kind of explains the relative and absolute underperformance and how the different themes contributed to that. And I think, George, your last question was about what has to happen to see an inflection in performance. Was that fair? So I think, what's been happening recently, the main headwinds really have been higher interest rates and also high inflation, which has driven costs up for many of these companies. It's compressed their margins, not just for the companies we own, but also the companies they serve as well. Consumer confidence has been weak because of the cost of living crisis. Really, it comes down, I think, largely to the macroeconomic environment. And so what we need to see now is at least a stabilization in that. We need to see confidence that interest rates aren't going to get higher. We have kind of seen flurries of that happening every now and then. Someone from the Fed will make a comment and the market will surge on the day because we think it's the end of the interest rate surge, and then something else will happen and it kind of reverses. So we still, although we are seeing a stabilization, starting to see the beginning of it, there is still uncertainty about what is going to happen with interest rates. And even when they do start to come down, there is uncertainty about what that kind of new normal might look like. I think it's unlikely that we're going to see an interest rate environment that's as low as it was pre-pandemic. I think the prevailing consensus is that it will end up about 3%, but really only time will tell. So we kind of need, interest rates to come back for inflation to really start to stabilize, and for consumers and for manufacturers to see a more stable environment, so they can feel confident to start investing more in capacity, and so they can see that demand coming through as well and manage their margins to a more stable level. So really, I think a lot of it does come down to the macro environment, and yeah, like I said, we do have reasons to be optimistic that that's improving. We have seen an inflection in demand for Vestas, which might be a leading indicator for the rest of the wind industry, if not the rest of the cleaner energy industry. We do have policy support from the US Inflation Reduction Act, which is still to come through in many cases. And we do start to see the beginning of a more stabilized environment, but it is still uncertain. There is still quite a lot of volatility. And so we just have to see how that kind of turns out.
Thank you, Claire. And yeah, a lot of ground to cover there. And we'll be covering more of that ground and in the longer term as well, when we come to our annual investor conference in a few weeks' time. So please do come in for that if you can. And we'll also be publishing the presentations online after that event as well. So there'll be more consideration of those factors. There's another related question that came in about whether, given we talk about relative and absolute performance, and some of what we have to explain is how we perform relative to a benchmark. And there's a question came in saying, do we look at benchmarks that have a closer alignment to our portfolio, given that the MSCI World Index and our universe have only about a 15% overlap, and the portfolio only has a 2 or 3% overlap with the index. And it's a good question, because it is a sort of an ongoing debate, and one that we look at our performance both obviously relative to mainstream, the opportunity cost of global equities in the MSCI World Index, but clearly our portfolio has got a lot of characteristics of mid-cap. We don't tend to own the very large companies, so we also internally look at our performance relative to the mid-cap index, and we find some correlation there, but we haven't chosen to use that as a separate benchmark, because ultimately the overlap of our universe with the mid-cap is relatively low as well, so we only introduce other discrepancies, but we do look at our performance in the context of both that larger cap index, the mid cap index, our universe, our opportunity set, and peers. So we're conscious that other peers in the impact sector are also having a difficult time as in this environment, as Claire has suggested. So we are somewhat constrained by being able to use all of those things as benchmarks, so from a regulatory perspective. So it does create constraints about what we can do publicly on that, but this is something that we're able to contextualize quite well in terms of understanding where the parts that are outside our universe are driving performance of the index. For example, the consumer megatech or the energy companies, where we've seen very concentrated performance in the mainstream index this year, and where those are structurally separate to what we're looking for, and then where there are things within our control. And we're obviously continually working on improving and developing what's within our control, and we talk about that, but also explaining that relative to what's more structural in the portfolio. So hopefully that's helpful on that topic. A couple of other questions that have come through. Just one for Seb, just in terms of you talking about AstraZeneca and other big pharma. Now, how do we approach and what are our concerns about ethical considerations on animal testing in that space?
Yeah, so well, I mean, I guess the reality is that the regulator requires these new therapies to be tested on animals before they can be approved. So there is an obligation on the company to do that or have it done on their behalf. We do look for policies from these companies that show that they are taking a responsible approach to that. So there's the 3 R's around refinement, reduction and replacement. And we're looking for evidence that they apply those rigorously in terms of how they commission animal tests and so on. We do actually also have exposure in the portfolio to companies that are building virtual models for animal testing. So companies like ANSYS in our global strategy, ICON as well, and then DASO in the European strategy are building virtual models where you can test products in a virtual context. You still need to do the real animal test for the regulator, but a lot of that work can now be done virtually and not require the use of animals. And one of the reasons we like those businesses is because they provide those kinds of services. So unfortunately, there is animal testing involved in pharmaceuticals. We look for a responsible approach, and we're also investing in companies that are trying to get rid of the requirement for animals in the earlier phases of those clinical trials as well.
Okay, thank you, Seb. Well, I did promise at the beginning that we'd be done by 11 o'clock, and it is now 11 o'clock. So we have got questions coming in, but I'm going to call a halt to it there, and we'll answer any other questions that come through by email, and if people have further questions, then please do get in touch. And otherwise, just the last plug for the annual investor conference on the 28th of November. As I say, the sign up on our website. Please do come along. We'd love to see you in person, and we think it'll be an excellent morning and hopefully give you more color on some of the issues we've been discussing today. So I hope that's helpful. Thank you very much for being with us this morning, and we look forward to seeing you soon. Thank you.